Most traders struggle not because they pick the wrong stocks, but because they ignore the foundational mechanics of market structure. To succeed, you must master two essential skills: reading market structure and analyzing volume to see what is happening underneath. When combined, these two tools give you the ability to read any chart with clarity, cutting through the noise of trading. By the end of this video, you will know how to identify where a trend is in its life cycle with precision. You will learn how to tell if a move is genuine or a trap, and how to use volume as your lie detector. Most people learn trends the wrong way by connecting dots and waiting for breakouts. But markets are not about geometry. Markets are fundamentally about crowd psychology, driven by who is buying, who is selling, and the emotions behind those decisions. Markets move in three layers, starting with the primary trend, which acts as the tide, lasting from months to years. You read this tide on weekly and daily charts by observing swing highs and swing lows to find the big picture. Rising highs and rising lows indicate a bullish environment, while falling highs and falling lows signal a bearish market structure. This primary trend is your compass, and every single trading decision you make must start by identifying this dominant direction. Within that primary trend, you have pullbacks, which are counter-trend moves that typically retrace a portion of the prior impulse. These pullbacks are not random accidents. They are zones where large institutional players reload their positions at much better prices. Every correction within a strong uptrend is likely big money quietly accumulating, preparing for the next leg of the move. Never try to read market structure on a 5-minute chart, as you are likely reading noise manufactured by high-frequency algorithms. These algorithms are specifically designed to trigger your stop losses, so avoid the temptation to trade on such low time frames. Valid swing points must be confirmed by closing prices rather than wicks, which can often be misleading or deceptive. A wick might spike past a previous high and snap back instantly, which is not a real breakout but a trap. This is a liquidity grab, where large players trigger retail stops to fill their own orders before moving the price. When a candle closes beyond a prior swing point, that represents a genuine shift in the balance of market power. This one simple filter alone will save you from countless false breakout traps that catch many inexperienced retail traders. Every major trend passes through three distinct psychological phases, starting with phase 1, which is known as accumulation. In accumulation, the asset has been declining, headlines are negative, and retail traders have either panicked, sold, or walked away. Behind the scenes, institutional capital is quietly buying within a tight sideways range, preparing for a potential reversal. Occasionally, price dips below that range to trigger stops and spike fear, but the price recovers right back inside quickly. That is not random price action. It is engineered to create the sellers that large institutions need to fill orders. Phase 2 is public participation, where the supply has been absorbed and the price breaks out with real momentum. Trend followers jump in here, creating large directional candles and expanding volume on moves that align with the trend. You will notice shrinking volume on the pullbacks during this phase, which is the longest and most profitable market stage. Phase 3 is distribution, where everyone is euphoric and social media is filled with excitement and profit screenshots. Right at that peak of excitement, institutional money is quietly selling into the flood of buying from retail traders. Price might still make new highs, but the gains are getting smaller and the candles are becoming increasingly choppy. Something feels wrong, even though the headlines say everything is perfect, signaling that the trend is nearing its end. This is the most dangerous phase for retail traders because it looks exactly like phase 2 on the surface. Accumulation and distribution look nearly identical on a chart, as both are sideways ranges with false moves above and below. The difference is context, as a sideways range after a long decline is accumulation, while after a rally, it is distribution. The same pattern means completely opposite things depending on what came before it, so always check the prior trend. Now add the second layer that transforms everything, which is volume, because price tells you what happened, not why. Volume tells you whether the move was real, using a framework called effort versus result to analyze the market. Effort is volume, representing how much energy went into the move, while result is the candle size and price travel. When effort and result align, the move is legitimate, but when they diverge, something important is happening beneath the surface. High volume with a large candle means genuine participation, suggesting that the move is likely to continue further. High volume with a tiny candle means absorption, where one side is pushing hard but an invisible wall soaks orders. When the pushing side exhausts itself, price snaps in the opposite direction, catching many traders off guard. Low volume with price drifting means the opposing side is absent, so price moves easily because the path is clear. There are 4 specific volume patterns every trader needs to recognize. Starting with stopping volume after a prolonged decline. You see a candle with enormous volume, but the close is off the lows, meaning deep pockets absorbed the panic. The second pattern is the buying climax, where a massive green candle appears with the highest volume on the chart. Most people see strength, but institutions are using that wall of retail enthusiasm to offload their entire position. The third pattern is the no supply test, where price pulls back slightly on very low volume during an uptrend. The market is quietly asking if anyone wants to sell, and the answer from volume is no, so the trend continues. The fourth pattern is effort without result at resistance, where price pushes into a level but the candle stays small. Someone large is sitting at that level selling into every buy order, signaling that the breakout attempt is failing. Volume divergence is your early warning system, showing that the trend is running out of fuel as it makes highs. Think of a rocket burning through reserves. As fuel depletes, the rocket slows and eventually falls back to Earth. Declining volume during rising prices is that exact signal that the move has not reversed yet but is getting tired. Follow a 5-step process. Determine the primary trend. Identify the phase. Wait for the pullback. Confirm with volume, and execute. If highs and lows are rising, only look for long opportunities. If falling, only look for shorts to increase probability. Market structure tells you who has been winning the battle, while volume tells you whether those victories are truly real. Together, they give you the ability to distinguish signal from noise and real moves from common engineered market traps. Once you have identified the underlying market structure, you must use volume as your built-in lie detector to confirm if price movements are genuine. The core framework here is the relationship between effort and result, where volume represents the effort and the price candle represents the final result. When these two factors align, the move is legitimate. But when they diverge, you are likely witnessing a market absorption or a sign of exhaustion. Think of effort as the fuel being burned, and the result as the distance the rocket travels. If you burn fuel but go nowhere, something is wrong. High volume with a large candle suggests genuine participation, meaning the move has true momentum and is likely to continue in the current direction. Conversely, high volume paired with a tiny candle indicates absorption, where an invisible wall of orders is soaking up every single attempt to push higher. When the pushing side finally exhausts its energy, price will inevitably snap in the opposite direction, often catching unprepared retail traders completely by surprise. Low volume with price drifting suggests the opposing side is absent, meaning price moves easily because the path of least resistance is wide open. You must learn to recognize 4 specific volume patterns, starting with stopping volume, which appears after a prolonged decline to signal institutional interest. In this scenario, you see a candle with enormous volume, yet the close remains well off the lows, suggesting deep pockets are absorbing panic. The second pattern is the buying climax, which occurs after a long uptrend when a massive green candle appears with the highest volume seen. Most traders see this as strength, but it is often institutional money using retail enthusiasm to offload their entire position into the market. The third pattern is the no supply test, which happens during an uptrend when price pulls back slightly on very low volume, signaling seller absence. The market is quietly asking if anyone wants to sell here, and the answer from the volume is no, confirming the trend is likely continuing. The fourth pattern is effort without result at resistance, where price pushes into a key level on heavy volume, but the candle stays small. This indicates someone large is sitting at that level, selling into every buy order, which means that specific breakout attempt is likely to fail. Volume divergence acts as your early warning system, occurring when price makes new highs, but each successive push happens on less and less volume. Think of a rocket burning through its reserves. At launch, the thrust is enormous, but as fuel depletes, the rocket slows and eventually falls. Declining volume during rising prices is that exact signal, showing the move has not reversed yet, but it is clearly running out of fuel. These patterns act as footprints left by institutional players, revealing their true intentions before the market makes its next significant move in either direction. By following a disciplined 5-step process, you can transform your trading from simple guessing into a systematic method of reading the market's true intent. Step 1 is to determine the primary trend on the daily or weekly chart, which alone eliminates roughly half of your potential losing trades. If highs and lows are rising, you only look for long opportunities. If they are falling, you only look for short opportunities, period. Step 2 is to identify which phase the market is in, as a tight range after a decline means accumulation, requiring you to be patient. Strong directional candles with expanding volume mean participation, which is the phase where you want to be actively placing your trades. An extended trend with euphoric sentiment means distribution, which is your cue to tighten your stops and prepare for a potential reversal. Step 3 is to wait for the pullback, because you should never chase impulse moves, as the best entries come at better prices. The ideal entry occurs when price retraces a third to two-thirds of the previous impulse, providing a much higher reward-to-risk ratio. Step 4 is to confirm with volume, asking yourself if the effort matches the result and if the key swing point held on closing. If volume is expanding on moves with the trend and contracting on pullbacks, you have a high probability setup that aligns with institutional flow. If any one of these factors fails to align, you must have the discipline to wait for a better setup rather than forcing a trade. Step 5 is to execute with discipline, entering with the primary trend and placing your stop beyond the most recent significant swing point. You must trail your stop as new structure forms and only exit when the structure breaks with real conviction and clear volume signals. Market structure tells you who has been winning the battle, while volume tells you whether those victories are real or just temporary traps. Together, they give you the ability to distinguish signal from noise and real moves from the engineered traps designed to trigger your stops. This systematic approach removes the emotional guesswork that plagues most retail traders, allowing you to focus on what the market is actually doing. By understanding the life cycle of a trend, you stop fighting the tide and start positioning yourself alongside the institutional players who move price. Remember that accumulation and distribution look nearly identical on a chart, so context is the only thing that will save you from mistakes. A sideways range after a long decline is a gift, but a sideways range after a long rally is a warning sign of distribution. The same pattern means completely opposite things depending on what came before it, which is why your structural analysis must always come first. As you practice this, you will start to see the market as a series of phases, rather than just a chaotic mess of candles. You will notice when the crowd is euphoric and when the institutions are quietly accumulating, giving you a massive edge over other participants. Stop looking for the magic indicator that predicts the future, and start looking for the footprints of the money that creates the future. Volume is the truth teller of the market, and when you combine it with structure, you gain a lens that few retail traders possess. This is not about being right every time, but about being on the right side of the probability when the move finally happens. Keep your analysis simple. Focus on the daily and weekly timeframes and let the smaller noise of the 5-minute charts fade away. Your goal is to identify the trend, wait for the pullback, confirm with volume, and then execute your plan without any hesitation or fear. If the volume does not support the move, do not trade it. If the structure is broken, do not hold it, regardless of your bias. Consistency in trading comes from having a repeatable process that you can trust, even when the market is behaving in unpredictable ways. By mastering these foundational skills, you are building a career that can last for years, rather than a hobby that ends in account depletion. The market will always try to trick you, but with structure and volume, You have the tools to see through the deception every time. Stay focused on the big picture. Ignore the headlines that are meant to trigger your emotions, and trust the data on your charts. Institutional players have to leave a trail because they cannot hide their massive orders, and that trail is exactly what you are tracking. Every time you see a fake out, remember that it is just a liquidity grab, and you now have the knowledge to avoid falling for it. This is the difference between a gambler and a professional. One relies on luck, while the other relies on a proven, logical framework. Take the time to review your past trades through this lens, and you will quickly see where you went wrong and how to improve. The market is a constant teacher, and if you are willing to learn, it will provide you with all the answers you need. Keep refining your ability to read the crowd psychology, as that is the true engine driving every single movement you see on screen. Ultimately, mastering this combination of structure and volume ensures you are trading with the institutional flow rather than falling victim to traps. You now have the framework to read any chart with clarity, identify the trend life cycle, and use volume as your ultimate lie detector.
If this clicked for you, share it with someone who needs to hear it and subscribe. Every week I break down exactly how the market works in plain language, no fluff, no noise, just the stuff that actually matters for your money. I will see you in the next one.